Hi everyone, today I'm going to introduce an approach to determine the entry and exit thresholds of pairs trading. The plan that I'm going to be going through is as follows. So first, I will give you a quick introduction to know the main ideas of the approach, then discuss the basic model followed by the extended model. And finally, I will demonstrate an empirical backtesting example. So a quick word about me. My name is Annie Lin, and I'm currently a quantitative researcher at Houston & Sons, and also a student studying finance and electrical engineering at National Taiwan University. This presentation and the module presented in the ArbitrageLab are based on a paper published by Bertrand in 2010 and a paper published by Zhang and Li in 2014. This approach was first proposed by Bertrand in 2010 and extended by Zhang and Li in 2014. It decides the optimal entry and exit thresholds by theoretically optimizing the expected return per unit of time, instead of maximizing strategic backtesting performance like the usual method did. In order to implement this approach, two problems must be solved. The first is how to calculate the expected time needed from one trade to the next, so we can calculate the expected return per unit of time. And the second is how to solve the optimization problem more efficiently, so the optimal thresholds can be solved in acceptable computing time. Now let's go to the basic model. In the paper called Analytic Solutions for Optimal Statistical Arbitrage Trading published in 2010 by Bertrand, the author derives the analytic formula for statistical arbitrage trading. By framing the problem in terms of the first passage time of the process, he first derives the expressions for the mean and the variance of the trade lengths. Then he derives the formula for the expected return and the variance of the return per unit of time. Finally, he resolves the problem of choosing optimal trading thresholds by maximizing the expected return and the Sharpe ratio. Below, we will first describe the assumption and the term definition of this approach, then introduce the formulas derived by the author, and finally explain the optimal trading strategies. Here, we assume the security price follows an exponential OU process. So the security price is defined as exponential of xt, and xt follows an OU process. To be noticed that the paper assumes that the long-term mean of the OU process is zero. We still extend this result so that the OU process whose mean is not zero can also use this method. We use theta for long-term mean, mu for mean reversion speed, and sigma for the amplitude of randomness of the OU process, which is different from the reference paper. The trading strategy is defined by entering a long trade when xt equals A, exiting the trade at xt equals M, where A is smaller than M. Here we assume that the traders can only make a long trade on the traded security. This assumption will be removed in Zhang and Li to get a more precise result. The trading cycle is completed as xt changed from A to M, then back to A. And the trade length T is defined as the time needed to complete a trading cycle. Here is the analytic formula for the mean of the trade length. We can see from the figure that when A is smaller and M is larger, the expected trade length will be longer. Here is analytic formula for the variance of the trade length. We can also see from a figure that when A is smaller and M is larger, the variance of the trade length will be larger. Here is the analytic formula for the mean of the trading strategy return per unit of time. So R here is the return we can get when the trading cycle is complete. And if we divide it by the expected trade length, we can get the expected return per unit of time. Here is the analytic formula for the variance of the trading strategy return per unit of time. We can see from a formula that this is not as straightforward as the previous one. One can study the reference paper for more detailed discussions. And to calculate an optimal trading strategy, we seek to choose an optimal entry and exit thresholds that maximize the expected return or the Sharpe ratio per unit of time for a given transaction cost and risk-free rate. This paper shows that the maximum expected return or Sharpe ratio occurs when m equals to theta minus a. Therefore, for a given transaction cost and risk-free rate, the equation here can be easily maximized to find optimal A and M. Now let's go to the extended model. In a paper called Peers Trading, Optimal Thresholds and Profitability published in 2014 by Zheng and Li, the authors enhanced their work in Bertrand, which assumes no short selling of the selected assets when finding the optimal trading thresholds. To resolve this assumption, they derived a polynomial expression for the expectation of the first passage time of an OU process with a two-sided boundary. Then they simplify the problem of optimizing the expected return per unit of time for choosing optimal trading thresholds to an equation solving problem. Below, we will first describe the assumption and term definitions of the extended approach, then introduce the formulas derived by the authors, and explain the optimal trading strategies, and finally showcase the trading example provided in the paper. So again, here we assume the security price follows an exponential OU process. So the security price is defined as exponential of XT, and XT follows an OU process. The trading strategy is defined on a dimensionless series Y tau transformed from the original time series XT using the formula shown here. We open a short trade when Y tau equals AD, and we close this short trade when Y tau equals BD. On the contrary, we open the long trade when Y tau equals negative AD, and we close this long trade when Y tau equals negative BD. Here is an example of the trading strategy. As we can see, we first open a long trade when Y tau equals negative AD. Then we close this long trade when Y tau comes to negative BD. Next, we open a short trade when Y tau equals AD, and we close this short trade when Y tau reaches BD. The trading cycle is completed as Y tau changes from AD to BD, then back to AD or negative AD. Or on the contrary, the trading cycle is completed as Y tau changes from negative AD to negative BD, then back to AD or negative AD. And the trade length T is defined as the time needed to complete a trading cycle. And here is the analytic formula for the mean of the trade length. We can see from the figure that since we have two side boundaries, the expected trade length here is smaller than the one in the basic model. Here is the analytic formula for the variance of the trade length. Since the exact formula is too complex, we didn't show this here. One can study the reference paper or our blog post for more detailed discussions on this topic. And here is the analytic formula for the mean of the trading strategy return per unit of time. We can see from the figure that since expected trade length here is smaller, the expected return per unit of time is bigger than the one in the basic models. And here is the analytic formula for the variance of the trading strategy return per unit of time. And to calculate an optimal trading strategy, we seek to choose optimal entry and exit thresholds that maximize the expected return per unit of time for a given transaction cost. There are two cases here. The first case occurs when BD is bigger than 0 but smaller than AD. The paper refers to this case as the conventional optimal rule. The second case occurs when BD is bigger than negative AD but smaller than 0. The paper refers to this case as new optimal rule. The equations shown here can be solved to get AD and BD for these two cases. After calculating optimal thresholds in the dimensionless system, we need to use the following formula to transfer them back to the original system. Now, the trading example. Here we use Pepsi and Coca-Cola to form the spread process. By setting the transaction cost equals 0.02 and using a new optimal rule, we can get the trading thresholds. The black points in the figure indicate the moment we do the trade actions. And here is a table that shows a detailed status for each transaction. Next, let's talk about a backtesting example. Here we provide a complete pure trading strategy extend from the trading example above. We're still using Pepsi and Coca-Cola to form the spread, but we redetermine all the parameters every 6 months with a 1-year history and do the backtesting on the following 6 months. By setting the transaction cost equals to 0.004 per round trip for the pure and using the conventional optimal rule, we can get the trading thresholds and do the backtesting on the testing data to get the cumulative returns as the figure shows. We can see from the table that although the strategy returns are not as good as buy and hold Pepsi or Coca-Cola, the strategy risks are much lower. And here are the references for these slides. One can study the reference paper for more detailed discussions on this topic. And thank you for the attention. And the link of the slides is available in the description.